how Wells Fargo shutting down their personal lines of credit, those products, and how it may affect you if you're a customer. What up? You got Mr. Smith, point five of Mr. and Mrs. Smith, and in this brief video I want to talk about some recent news that surfaced pertaining to Wells Fargo and them shutting down their personal lines of credit. What they did was created a product that allowed for personal lines of credit to be drawn out. I saw anywhere from 3,000 to 100,000, which gave people the ability to consolidate some of their credit card debt at a lower interest rate, which also allowed people to do home renovation. And I'm sure plenty of people did other things such as investing, real estate, things of that nature. But the lines of credit gave people another option in order to do something that they wanted to do, regardless of what it would have been. Now, if you're a Wells Fargo customer, then you might want to listen up. If not, then you might want to listen up as well, due to the fact that lines of credit play a significant role in your credit score when it comes to a couple of different things. And they can be a powerful tool when used correctly. But unfortunately, in this situation, if they carry out what they said they're going to do, those lines of credit will no longer be available. So what is a line of credit? A line of credit is basically revolving debt. It operates very similar to a credit card. That's what a credit card is. A line of credit is revolving debt. So it's no set interest rate per se. Yes, they have an interest rate, but you can go against the grain and pay it off a lot faster and save a lot of money on interest. As it relates to a personal loan, which is installment debt, when you have the interest rate attached to it, it's non-negotiable. You can pay it off in advance and the interest rate is still built into the payment overall because they factored it in your total. So for example, if you borrow $10,000 and the interest rate is whatever, and now you have to pay back $13,000, the fact that you pay $13,000 off in a month or in a year doesn't matter. You're still going to pay the same amount because it's factored into the total amount. With a revolving line of credit, basically it can have an interest rate attached to it, but it accrues on a monthly basis. So based on your balance is what your interest rate is for that month, which means that if you decide to pay it off in 5 months, in less than a year, you will pay less than the individual who made the minimum payment and paid it off in 2 years, just as a brief example. Why is that also important as it relates to your credit? Well, since it operates like a credit card and it's a revolving line of credit, it plays a part as it relates to your utilization. So as your balance goes down on a revolving line of credit, so does your utilization, hence heightening your score. Or if you have a line of credit that you haven't tapped into, that gives you a massive amount of basically buying power in the form of credit utilization, which can heighten your score greatly. I had a client who had a new line of credit and their score went up like 300 points across the board because their line of credit that they added to what they already had in credit cards was significant enough to make their overall balance of credit utilization low. So for those who lose this account, what's going to happen is you're going to lose a large line of credit and it can drop your score due to credit utilization alone. That's 30% of your score. That's 165 points. And it can drop it significantly, especially if you have some credit cards that have a balance. So it's a good idea if you have credit cards to make sure that utilization is under 10%, because if you lose that line of credit, then it's no longer going to be being factored in into your overall credit utilization, your revolving accounts, which will hurt your credit score in that situation. So I hope that makes sense. I hope you understand the significance of it. That line of credit going away automatically lowers your credit utilization. For example, if a person had a $50,000 line of credit that's now being converted into a loan, because that's what's about to happen, they're going to convert those lines of credit into a regular loan. So now the bank is automatically going to get whatever fixed interest rate they put on there. Now that turns into a loan, and what that does is increase your debt to income ratio in many cases and removes that $50,000 that you may have had in the form of a line of credit if you had a balance on that line of credit, hence hurting your score in the areas of credit utilization. If you want access to some more things that can help you better your credit, whether you want to do it yourself or you want to hire some help, click one of the links available below so you can set up a consultation, or you can skip the line and just get in motion so we can start working on your behalf if you so choose. Or if you want to learn to do it yourself, I'm sure that link is available down below as well. That's all I got for this video. Mr. Smith signing out. Salute.